Welcome to It's Personal, Finance Canada. I'm Christine Conway.
And I'm Cameron Conway.
And this podcast is a very personal look at personal finance in Canada. Welcome to It's Personal Finance Canada. I'm Christine Conway here with Cameron Conway. And if you're in BC, Alberta, Saskatchewan, Manitoba, Ontario, or the Yukon, feel free to find us at braunfinancial.com. So this week I was thinking about FIRE. That's Financial Independence Retiring Early, and specifically people that want to retire young. And I mean like really, really, really young, like 40s, 50s, that kind of thing.
Yeah, so we've kind of talked about FIRE movement before, but today we want to talk about the famous Trinity study. Or you can call this episode, Everything You Don't Know About the Trinity Study is Actually Wrong and Will Destroy Your Retirement.
No. You know what? I think anytime anyone is planning to retire early, there's additional checks and balances that you need to put into place. And the Trinity study, I think it's so funny because it's so famously referred to time and again in the FIRE movement, but it's actually not at all about early retirement. The timeframes that it looks at longest is a 30-year period.
Yes, people like to quote the Trinity study, but no one actually wants to read the Trinity study.
And guys, it's super, super short. If you find it, it is a quick read. There is lots of great information there, and the details will really help you understand the point that the authors were trying to make. And of course, these are professors at a university in business trying to kind of get this figured out for the average person who wants to know how much they can take from their retirement savings.
Yeah, this is the study where like the 4% rule came about, but it actually wasn't them creating the 4% rule. It's just a column that a bunch of people liked and just talked about a lot.
Well, and I think there's other sources as well, but particularly for this podcast, we're going to focus on the Trinity study. So I'm going to look at some cautionary things that I think will help you out if you find yourself part of the FIRE movement and have just been doing kind of quick and dirty calculations online with a financial planning calculator. And I'm also going to talk through my top 5 things that I think will help you have more success if you do decide you're done trading your time for money, you want to retire early.
So let's stop talking about sort of like the buzzwords about the Trinity study and actually start getting into the hard details of this academic paper. Because if that doesn't get you excited, I don't know what will.
That's right. Okay, let's start with its real name so that you can find it. It's actually called Retirement Savings, Choosing a Withdrawal Rate That Is Sustainable. And the authors are Philip Cooley, Carl Hubbard, and Daniel Waltz. So again, 3 professors out of Trinity University in the States, which is how it got its kind of infamous name.
I thought it was because they had 3 authors.
Maybe, but no. It's actually the university was caused at Trinity. So let's start talking about the Trinity study by addressing what the authors themselves say as the opener. So I'm going to read this part to you verbatim. Most investors who plan for retirement eventually confront the question of how much money they should plan to withdraw annually from their investment portfolio. The dilemma is that if they withdraw too much, they prematurely exhaust the portfolio. But if they withdraw too little, they've unnecessarily lowered their standard of living, end quote. So, I mean, that kind of sounds like a rock and a hard place, right? You don't want to live less than you could. You don't want to give up good experiences you could have had, especially if you're retiring early and you really, really, really want to make your life count by using your money to the best of its ability. But at the same time, you don't want to take out too much and find yourself in an incredibly vulnerable position where the portfolio hits what they call a failure rate and it does not sustain. So you end up with more time than you have money.
Yeah, so the real purpose of the study was to kind of find that Goldilocks zone of your rate of withdrawal so you can have the mix of a long standard of life where you're comfortable, you're not leaving money on the table, and you're also not depleting it prematurely. So they threw a whole bunch of scenarios at the wall and they tried to figure out which idea would give you the best long-term quality of life.
Sounds like science to me, or at least something like what a math professor would want to do.
Well, because it's only science if you write it down.
And it doesn't count as math unless you've published it in an academic journal?
That's how they get tenure.
Well, let's go to one of the most important takeaways in this study. And this is about asset allocation. So the way that the authors address this is they actually looked at 5 different asset mixes. And they also encouraged us in the wording not to look at your rate of return as something that's static. And the point of the period of history that they captured is that they wanted to show the actual historical rates of return. Now, keep in mind that for us sitting here today in 2025, this is a long time in the past. This history is a bit of a way behind us because the study does start in 1925, and I believe it runs to 1995. So that is a period of history that is maybe dramatically different than where we find ourselves sitting today.
Yeah, so the justification is, this got the Great Depression, this got stagflation in the 70s, but it hasn't been able to capture kind of what we've had in really the last 5 years, which is like up, down in a very, very condensed way, or you all of a sudden have companies and stocks that normally wouldn't be growing 30, 40, 50% year over year. It would normally be like 2 or 3%, but things have just gone completely insane. So your mileage may vary with some of the math that was used back in the mid-90s here.
Yeah, the chaos that we've been experiencing on the daily since COVID was not factored in, but of course they had their own challenges and struggles as well. So let's look at the 5 different scenarios that they compared, the 5 different asset categories and mixes that they used so that you can understand the importance of asset allocation in this. First off, they looked at 100% stock. Secondly, they had a mix of 75% stocks and 25% bonds. Then they had a 50-50, so a nice split, even split between your stocks and bonds. And then 25% stock, 75% bonds, and finally, all bonds.
Yeah, and I guess the kind of disclaimer is that to them, the stock was the S&P 500 and the bond was corporate bonds.
Yeah, well, I think they just kind of picked the most popular American index. This is, of course, an American study, so that would make sense. And the withdrawal rates that they tested ranged from 3% to 12%. And remember, they are trying to see how these categories, these asset allocations held up with those withdrawal rates over this period of time.
Yeah, and a spoiler alert, all bonds did not work well.
All bonds did not. That is when you kind of learned the lesson that stocks were actually needed, not only just as your inflation kind of protection, but you needed that growth to kind of sustain this over a longer period of time. And someone who's trying to be safe with their money and trying to be conservative, being too conservative actually ended up hurting them. And they depleted their assets faster than someone that had taken on a little bit more market exposure.
Yeah, and again, they use corporate bonds here. So I know a lot of people, they tend to gravitate towards like Canadian government bonds because that's sort of like the safe and steady, but it's got a lower coupon than the corporate ones. Like some of the funds I've been looking at recently, like the all Canadian gov is like 3.25 to 3.8 with the average coupon yield is on. And then on the corporate side, we can get stuff like 6-7% still. So this is a more juiced up bond, and it showed how people were struggling a lot quicker, and you can just amplify those numbers downward if you're just relying only on like the safer government bonds.
So that was important. These are all really important factors, but let's step back for a minute and ask the original question, because they are trying to figure out what percentage you can safely take out of this portfolio. And when you're thinking about outliving your money, will I outlive my money? There's actually 2 questions, 2 core questions that are built into that. The first one is, how long will I live? And of course, that's a great unknown. You might guess a bit with family history, with your own health history, with things like that, but it's something that none of us know, of course. And the second, another great unknown, but this is what they were trying to test, is how long will your money in your portfolio last? And like we said, the results varied considerably if you read this study based on how you had your money allocated.
Yeah, so a big part of this study was trying to figure out how long this money could last. So that's why they used the 5 different breakdowns between stocks and income and the different withdrawal rates. They're trying to find what could be like a safer area. And this is where like the 4% came in. Just the way the numbers worked out, it had a generally good longevity. 3 did even better. And after 4, it kind of trickled off where if you were like all stock, you were able to last the longest. If you had all bonds, you ran out of money the fastest. And so you're trying to peg yourself into where do I think I'll be? How many years do I need this for? And what number is the quote unquote safe withdrawal? But as we've kind of seen with reality, that number is going to fluctuate every single year. Like one year you could be negative double digits, another you could be positive double digits, and you're just trying to figure out what will actually sustain me over the long term.
Well, and an interesting part of the study as well is once they factored in inflation and adjusting your portfolio for inflation, that's when the safe withdrawal really dropped, right? That's when it started looking worse per se, and you couldn't quite take out those higher percentages that people were thinking they could take out before. But yes, along with all of this, the big question to ask yourself is how long will your retirement last? So if you're the person retiring early, think about your life as a timeline and try and figure out what this would look like if the plan failed. What would happen if it didn't go to plan the way that you wanted it to? What could you do? I mean, barista fire is a very popular part of the fire movement where some people will say, you know what, I'll just get a part-time job, something nice and easy, pay my bills on the side, and consider myself fired because I've stepped out of a high-stress, fast-paced environment, or I've partially retired, maybe I'm only working a little bit of the time. But knowing your own timeline and understanding how long you need your portfolio to last is very, very crucial, because the longer that the portfolio was subject to the ups and downs and the ebbs and flows of the market, the more likely it was to fail in the sense that it could deplete down and run out of money.
Yeah, and again, inflation is the big X factor here where it can quickly erode that growth base you've got, where you could lose like a bigger chunk in a couple of bad years like we just saw in like 2020, 21, 22, a bit of 23, where people had to take more out to maintain that purchasing power. So if this gets timed out wrong or there's another prolonged inflation track, this will deplete that money even faster.
Absolutely. So let's start with some of our cautions around using this study and just using the 4% rule. So like we've said already, this is based on historical data. We will never have an exact copy of what we've lived before, and neither would we want to, right? We learn and we evolve as a society from the things that we've experienced. Things are so different today than they were in the past. You could argue that the markets are cycling faster than ever. But the truth of the matter is, for all of us, is we have no idea what the future will hold, or even how closely the next decade or 2 decades or 30 or 40 years will mimic what had happened in 1925 or even all the way up to 1995. These are vastly different periods in history. And this is very, very important because as we've advanced as a society, as things have changed, even as geopolitical stuff changes on the daily, it alters the outcomes. So we can't expect what we've seen before. It's like they make us say when you sell any kind of fund, past performance is never an indication of future returns.
Yeah, like Christine said, you will not have the same market. You can't have the same 10 years happen over and over and over again. There's ups, there's downs, there's technology changes, there's political changes, there's things that shoot it up, there's things that shoot it down. And then we try and hope for these little brief moments in between where we just have like a normal growth cycle, which has been lacking for the last few years, which has complicated a lot of things.
Well, and that brings us to our next point, our next caution, which is sequence of return risk is a real factor. So we've talked about this before, where there are studies that have been done that have essentially said that if you have a down market early on in your retirement, it can adversely affect the rest of your retirement, and more importantly, the longevity of your money.
That's a very fancy way of saying you're doomed.
You're not doomed, but it might not be as fairy or as nice or as pretty as it might have looked like when you did your calculations if you hadn't stress tested or back tested them, especially if you used a static rate of return, as the authors have kind of cautioned us against. History isn't important because it does capture those ebbs and flows, even if history varies, like we just said. So Sequence of return risk. Yes, we know that if you hit a bad part of the market and you're just starting, this is not good for you. But there's another factor of this that can look and feel very similar to sequence of return risk that I think people don't really think about. And that is when people retire, they are usually ready to go. They are at their healthiest, they've been working, they're finally free, their time is their own. And typically we see that the first 10 to 15 years of someone's retirement are the most expensive years. So if you look at portfolio allocations and if you look at your own withdrawals and you say, well, all of this was designed to see how much I can take out every single month or every single year, and then you go, well, wait a second, how am I going to fund these extra fun things that I want to do that are on my bucket list? And you say, okay, well, hey, I'll just take a lump sum out of my portfolio. Well, if you've done a big withdrawal at the beginning of your retirement, you could have created your own sequence of return risk in that you could have had an adverse impact on your portfolio if that portfolio was what you were looking at for your lifestyle cash flow expectation. So the monthly amount you were expecting to live off of.
Yeah, you can have your plan all set up and all of a sudden you go on a vacation or you buy a car out of nowhere. And this can really chip into what you'll be needing to take out of your investments in the years that follow onwards.
So the remedy to that is really quite simple. It's just doing the planning for both. It's having money set aside for the lump sums. I like TFSAs for this just because they don't impact your overall income from a tax perspective, and you can take as much or as little as you need in a year without affecting the overall flow or your income tax return. But this has to be done kind of as side-by-side planning. So you might take certain pools of money that you say, this is what I need to spend over the next 10 to 15 years on lifestyle, and not count that in your overall calculation if you're trying to figure out what your monthly amount will be on a consistent basis.
Yeah, and then on the opposite end, like we said before, is so you can go on the very, very conservative route and not spend a single dime and have a mountain of income that you just can't spend at the end.
Well, that's it, right? These authors are trying to find that sweet spot of how much should you spend, and no one, regardless of a study like this, is going to hit it perfectly. Because like we said, this whole is premised on two unknowns: your life expectancy and how the market's going to do, how your particular asset allocation is going to perform over this long period of time when you're not working.
Yeah, this is why at Braun, we kind of play the age to 100 game just to make sure we can do this right.
Always. And have that understanding that being too conservative can hurt you. Yes, risk tolerances are so important and we do have to follow them, but we have to make sure that your portfolio is at least keeping up with inflation and hopefully growing as well, because you need that growth as a buffer for the withdrawals that you're going to be making. Next, I would say that portfolio longevity planning, this is an exercise in probabilities. So I like looking at things like Monte Carlo simulations, which are basically a way of illustrating that you can have multiple outcomes to a same singular event. Things can go in so many different ways, and you can even, depending on how your money is distributed and allocated, you could have a completely different outcome than someone who is allocated in a different way than you. So financial planning, I say, happens in ranges. No one can give you the magic number that you're going to hit and consistently hit forever. Financial planning and retirement planning is all about choice and flexibility.
Yeah, if you understand what Monte Carlo simulation is, just think of the movie Groundhog Day, except it's your retirement plan.
Oh, no. And you may or may not have the opportunity to change the outcome for the better. There you go. Let's talk about one more way that retiring early specifically can impact you later on in life. And this is looking specifically at government benefits and your fixed sources. So a lot of people rely on government benefits to provide like a little mini pension for them. It's a source that can't be depleted, that indexes, and it's nice to have. And if you do traditional retirement planning, I'm a big fan of matching expenses. fixed sources like a CPP and an old age security to a fixed expense. Now, if you step out of the workforce or if you leave the country for a prolonged period of time, there may be an impact on your CPP or your old age security. CPP is based on your contributions into this plan. It's essentially a forced savings program where both you and your employer have to put in and save for your retirement on your behalf.
Yes, the government finally figured out that people weren't doing this on their own, so they're forcing you to do it now.
Exactly. You know what? You don't have a choice. Neither do I. Neither does your employer. We're all putting money in, and it's to get this big wheel turning, to keep it going round and round. But even OAS being based on residency, a lot of people have plans to leave the country or to travel for a while and then maybe come back, maybe go again, maybe come back. It varies person by person and case by case. So looking into what that could be like for you is something that could be important as well.
Yeah, and again, this is something that people who go pretty deep into FIRE could miss out on is you stop working. Your CPP check at the end is a lot smaller than because you're not losing 10, 15, 20 years of income going into your cut of the CPP. So this is something that has to be factored in. So you have to rely even heavier on your own personal savings to make up that gap between what you could have got with CPP and what you were actually going to get because you stopped working early.
So let's flip the script now and talk about what will lead to success, or what will, in my opinion, increase your probability of success, because like we've said, this is all an exercise in probability. Nothing ever goes exactly to plan, but if there's things that you can do to kind of increase your advantage, it's certainly worth your while. The first point here for me is replenishing sources. So in my mind, there's a problem with having all your eggs in one basket. People love investing in stocks and bonds. I do too. We do it professionally. We do this for a living. Yes, you get a rate of return. It's good. But as you spend the money, as you decumulate, it's on a diminishing basis directly related to the size of your portfolio. So how do you counter this? It's having a source that will bring in some new money for you that's not just tied to a rate of return. Now, this may not be as easy as investing in the market because there might be some work involved. It might be something like a rental or something that generates a royalty or even an active or passive business that you do part-time. This can be a bit trickier. It can have its own ups and downs, its own business cycle. But if you have more than one source, if you have your money in more than one place, and if at least one of these sources replenishes, that can increase your chance of having additional funds coming in at a time when you need it the most.
Yeah, so this is like Christine said, you don't want to rely solely on your investments. You want some other source of income, recurring dividends, royalties, work, something else, just something other than something that is tied directly to the market or a government yield.
Absolutely. And it will have its own form of downturn, right? Like if you invest in real estate and you have a rental, maybe your rental is vacant for a period and that stops. Or if you have a business, maybe that particular market dries up and that kind of closes down, but at least you've tried to have more than one source. You've had different streams that will act differently in different economic positions and situations. So in my mind, that strengthens your chances of success.
Yes, this is just the diversification conversation, or even with funds, we all mix like growth funds and value funds, Canada funds, US funds, international funds to come up to some sort of mix where not all of them will be great that same year, but enough of them will be great to offset the ones that are bad that year.
Well, and that's the point. It's the overall performance of your portfolio. So if you're looking at your sources of income as your own portfolio, that's exactly what you're trying to do. And if I'm doing traditional retirement planning and I'm matching fixed expenses with fixed sources, maybe for people that are retiring early, we're trying to match fixed expenses to replenishing sources, especially if we know that that retirement is going to be long. So this is where you're assessing if a rental is worth the work, or if it cash flows properly, or if a property management company makes sense, or if that business idea, what would it take to get it off the ground? Could someone run it for you? What do you have to do yourself? What is the investment of time and effort? And of course, what is the risk and liability on the downside for that as well? Next on the list, so if you want your assets, your active investments, so the ones in stocks and bonds, to never, ever, ever run out of money, there's only really one way to do this. Only spend your gains. Do not touch your principal. Don't even look at it. Set it up that you have a dividend that's paying to you. You just cash in the dividend. Or if you're in bonds or GICs, you're just receiving that interest payment. You're not selling the underlying asset. Or if you have to sell it because it's a GIC, you're reinvesting it. So downside to this is, depending on how much cash flow you need, you might need to save a very large amount to make this happen. But of course, that will all be relative to your own particular spending needs.
Yeah, we see this a lot with like GIC clients where you need like a good chunk of money to make this program work, because you might only be getting maybe 3% right now. And is that 3% enough to pay your bills for the year? So you need a good lump sum. So you can play this game with GICs, you can play this game with the yields on bonds, depending on what kind of dividend structure or income outflow structure a fund might have. It's just trying to leave it so the principal, it stays intact, and everything that comes in that year, if something comes in that year, goes to pay your bills.
Well, and the downside of this strategy is maybe there isn't that inflation adjustment that you need, depending, of course, on your asset mix and what portion or proportion of your portfolio is allowing additional growth. Because like we said, if we don't want to spend the initial investment, we only want to spend the gains, you would need a portion of your portfolio invested in something that could grow a little bit more. Number 3 on my list is going into this fire scenario, especially if you're doing it early, with the lowest expenses possible. And what this means for me is you've paid off all your debts, and I would include in that your mortgage. And the reason I add the mortgage is because anytime your payment can change at the whim of an interest rate change, that affects your whole budget, especially if you're trying to live off of a fixed source. That also might mean that you've downsized. You might have right-sized your home, gotten into the community or the area that you want to spend your time when you're retired. But I think this whole point about budget is really not only just knowing your expenses, what you need to spend, what is optional to spend, but also having flexibility with it so that when we are in these down periods, these downturns, you are okay in the sense that you don't need to spend extra, and you'll actually take in and spend less than you would in a good year when the times are positive.
Yeah, so those first 3 tips is a lot of what you can do with your own money right now. But our 4th tip is actually something a little bit different. This is something you're going to spend money on to help you get a return later.
It's true. Number 4 is don't forget about insurance. So life insurance can be...
And we know people do because they're our least watched episodes.
It's true. But there's such good tools and they help you so much. So life insurance can be a really important tool for anyone that wants to fire, especially if you're part of a couple. So if you are part of a couple, this can be a lump sum to the surviving spouse through insurance at a time when they might be vulnerable otherwise. Or alternatively, if you do want to leave gifts to your kids and inheritance to your kids, but you also want to spend all your money on a great time, insurance can take care of that for you. So by working the premium into your budget, you've got it taken care of, and now you can kind of spend guilt-free. Maybe the guilt wouldn't have been there at all, but you can spend knowing that this is one more thing that's checked off the list. The kids will get what you want them to receive later on. And I would add to the insurance conversation critical illness and health insurance. So this is protecting your nest egg from the event that anything could go wrong that would require you to take money out, not for your lifestyle, not for your enjoyment of life, but to fund this deficiency. So it's protecting that cash that you've set aside, that you've invested diligently all these years, and making sure that if there is an issue, you have insurance in place to address that. And you have health insurance to address any ongoing medication or costs or medical devices that you might need if it's covered under that particular plan. Finally, the last one is having hard assets going into fire that you're okay to sell if you really need a backup plan. So if all else has gone not according to plan, you're on the worst case scenario in your Monte Carlo simulation, and you don't want to go back to work. Maybe you've gotten a little older, maybe your skill set has changed with time. if there's an asset to sell, this can kind of be your Hail Mary in the retiring early. So this could be a home, it could be a rental, it could be any asset really of material value that could give your portfolio an injection of cash flow. And then we could do a recalculation of that safe withdrawal rate that you're using. So all of this to say that when I read the Trinity study, I think the safest withdrawal rate was actually 3%. I don't think it was 4%. But that being said, understanding your investments, your portfolio, your timeline, when you want to retire, and your objectives are so important in making this money last. There is a lot of testing, I think, beyond what is typically done in the quick and dirties that you can kind of see online. And that is the importance of talking to someone about this that understands this type of financial planning. So if you find yourself living in BC, Alberta, Saskatchewan, Manitoba, Ontario, or the Yukon, and you'd like to talk to us, find us at Braun Financial, braunfinancial.com. Until next time, take care.
And all the best.